Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the world of big business. And sometimes things get a little hairy like a movie theater on a Saturday night, but that is what we're here for. And before we get started, if you appreciate getting no-nonsense insights directly from these dense corporate filings, you know what to do. Hit that subscribe button and join our Discord community linked in the description below for even more in-depth discussions. Today we are peering into the latest annual report from National CineMedia. Incorporated, this document tells the story of a company that's navigating what looks like a pretty complex landscape, and we are going to unpack it all. We are looking at a company that's been through a lot, especially with that bankruptcy filing we'll touch on later. They are essentially the biggest cinema advertising platform in the US, connecting brands with moviegoers. Think annoying ads before the movie starts, that's them, but also a whole lot more happening behind the scenes. Their network is massive, covering over 17,000 screens in more than 1,300 theaters across the country. A big recent development in November 2025 was their acquisition of Spotlight Cinema Networks, adding more luxury and art house screens to their arsenal. This acquisition was about a $8.2 million deal, and it means they are now reaching even more niche audiences and adding about 6% to their national market share. Now let's talk about a major deal they struck in April 2025 with AMC. Incorporated, this deal extends their main advertising agreement by 5 years, and it helps align the ads shown across their network, which sounds like a good thing for advertisers. As part of this, they seem to have settled some old financial matters with AMC Incorporated, which resulted in a significant adjustment to their intangible assets. Financially, things are also shifting. In January 2025, they secured a new $45 million credit facility with US Bank Incorporated. This is important because it replaced an older credit line, and it's giving them more breathing room with a longer maturity date. As of early 2026, they had $12 million drawn on this new facility. Now, something interesting happened back in August 2023. They did a 1-for-10 reverse stock split. This essentially reduces the number of shares out there, which can sometimes help boost the stock price and keep a company in compliance with stock exchange rules. They did this partly to meet obligations from a settlement and also to improve their stock price. On the shareholder return front, they approved a program to buy back up to $100 million worth of their own stock over 3 years. They've been actively doing this, repurchasing about 4.1 million shares just in the most recent fiscal year. A big shift was the departure of Regal Cinemas Incorporated from their main advertising agreement in July 2023. Regal filed for bankruptcy reorganization, and while they terminated their old agreement, they entered into a new network affiliate arrangement. This means Regal is no longer a direct partner in the same way, but they are still connected. This was a huge negotiation that involved settling a lot of old claims and agreements. And speaking of bankruptcy, NCM LIC itself filed for Chapter 11 reorganization in April 2023. This was a major event leading to a company-wide restructuring. They emerged from bankruptcy in August 2023, but the process had a big impact on their financial statements and how they reported their results during that period. Essentially because the company lost control of NCM LLC during bankruptcy. It was deconsolidated, meaning its financials were kept separate for accounting purposes, and then reconsolidated once they emerged. Let's get to the numbers for the year ending the 1st of January 2026. Total revenue was $243.2 million, up slightly from $240.8 million the previous year. That's a 1% increase, basically about $2.4 million more revenue. National advertising revenue, a big chunk of their business, saw a 3.5% increase, reaching $194.5 million. This was driven by more impressions, meaning more ad spots being shown, and an increase in attendance, partly thanks to that extra week in their fiscal year. However, they strategically lowered their advertising prices, or CPMs, by about 18% to get more utilization. Local and regional advertising revenue, however, took a hit, decreasing by 11.5% to $34.6 million. This was due to less contract activity in certain industries like pharmaceuticals and automotive. On the expense side, total operating expenses actually decreased by 1.2% to $257.1 million. This is good news as costs went down even with some rising expenses like theater exhibition fees, which went up 5.9%, probably due to the Spotlight acquisition and contract rate increases. Despite the revenue increase and expense decrease, they still reported an operating loss. For the year ending the 1st of January 2026, the operating loss was $13.9 million, an improvement from a $19.5 million loss the year before. This translates to a net loss attributable to NCM Incorporated of $10.6 million. That's about 52.5% better than the $22.3 million loss they had in the prior year. But still a loss. Now looking at a non-GAAP number that management likes, adjusted OIBDA margin, which helps show the core operational performance, was 16.1%, down from 19% the year before. This shows that while the net loss improved, the core profitability margin took a small step back. Looking at their cash situation, they had about $34.6 million in cash and marketable securities as of early 2026. This is a decrease from the previous year, but they also have access to that new credit facility, providing further liquidity. The table shows that while total liquidity decreased, a significant portion of that cash is held by NCM LLC and not directly available to NCM Incorporated for things like dividends. Cash flow from operations was $8.4 million in 2025, down significantly from over $60 million in 2024. This drop is mainly due to changes in deferred revenue and accounts receivable collections. Investing activities show they used more cash in 2025, mainly because of that Spotlight acquisition and other strategic investments. Financing activities show more cash was used in 2025, primarily for paying dividends and repurchasing stock, which we mentioned earlier. Now let's look at the big picture reported numbers, their tangible and intangible assets. The balances shows that as of the 1st of January 2026, they have $490.6 million in total assets. A huge part of that is intangible assets at $308.8 million net of amortization. These are things like their advertising rights and customer relationships. It is clear a big chunk of their value is tied up in these agreements. On the liability side, current liabilities are $62.1 million with accounts payable making up a significant portion of that. Long-term debt stands at $12 million. Their retained earnings show a large deficit which is tied to their history, including that bankruptcy. However, their additional paid-in capital is substantial at $136.5 million. Looking at revenue recognition, they break it down into national. They got $194.5 million local and regional, at $34.6 million and beverage concessionaire-related revenue at $14.1 million. One more thing before we get to our take is their deferred tax assets, which have a valuation allowance of $160.8 million. This means they don't expect to realize all of those potential tax benefits, which is often a sign of past financial struggles. Looking at their strategy, they are focused on increasing the value of CineMedia through innovation, expanding their marketplace with data and programmatic capabilities, and optimizing operations. They believe their extensive national coverage, along with state-of-the-art technology and an engaged audience, are key strengths. However, they also acknowledge the risks of competition, technological dependence, and economic uncertainty. The income tax provision table shows zero tax expense for the year ending the 1st of January 2026. This is largely due to that valuation allowance and past losses, which means they are not currently recognizing significant tax benefits. So what is the story here? National CineMedia Incorporated is walking a fine line. They undeniably have scale and a strong presence in the cinema advertising world with key partnerships and a recent acquisition that expands their reach. The fact that their revenue ticked up and their operating expenses decreased is a positive sign. They're also managing their debt better with that new credit facility and actively repurchasing shares, which can signal confidence. However, the lingering effects of bankruptcy and past losses mean they are still operating at a net loss. That large valuation allowance on their deferred tax assets is a significant red flag signaling they haven't yet reached a point where they can consistently generate enough taxable income to utilize those potential tax benefits. The drop in local advertising revenue and the slight dip in their adjusted OIBDA margin also indicate areas of weakness. The company's direction seems to be focused on diversifying its offerings beyond just the pre-movie ads with data and digital products and trying to enhance the value of existing inventory. The Spotlight acquisition is a clear move to capture new market segments. Their long-term agreements with theatre chains provide a degree of stability, but the reliance on these agreements and the theatre industry itself remains a significant risk. In conclusion, National CineMedia Incorporated is in a recovery phase. They are making progress in terms of revenue growth and expense management, but profitability and a strong positive cash flow from operations are still hurdles they need to clear. The company's ability to truly capitalize on its market position and effectively integrate its new ventures will be key to its future success. It is a company with a solid foundation in a niche market, but it has still got a ways to go to shake off the impacts of past challenges. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And don't forget to check out the Discord in the description. Thanks for watching. See you next time.